One income decision made years before your student actually goes to college could quietly cost you tens of thousands of dollars. And unfortunately, parents realize this all too late. My name's Monica Felton, and I'm a college planning expert, a college financial planning expert. And today we're going to look at the impact that income has on the FAFSA. FAFSA is heavily income driven and can significantly reduce any potential aid that a family can have. Income is assessed 10 to 25% depending on how much your adjusted gross income really is. Many families will unintentionally disqualify themselves for financial aid because 1 year impacts multiple years through college. The FAFSA uses something called the baseline year to determine financial aid for 4 years. The baseline year is 2 years prior to your student actually going to college. So if your student is going to college in 2028, they will be looking at 2026 tax return. If your student's going to college in 2026, they will be looking at 2024's income. Now, the challenge is that baseline year is going to determine 4 years of financial aid. Once that baseline year is locked in, there's very little we can do to change it. Common mistakes that families make is they time bonuses incorrectly. If at all possible, we don't want to take large hits of income, sell a house, any large taxable event in that baseline year. Families might take significant distributions in the baseline year that would spike income. Many families just automatically assume they're not going to qualify for any need-based financial aid, and they do that prior to even running the numbers. A biggie for families is planning for college without even looking at the impact that it's going to make on mom and dad's retirement. With advanced planning, families can often reduce the income that is used in the FAFSA, therefore increasing their overall financial aid. Here are some strategies that you could employ. Number one is maximizing contributions made into a qualified plan. Accounts like 401ks or 403bs or IRAs, these are pre-tax accounts and actually can lower the income that's used to calculate your student aid index or SAI. Timing bonuses, commissions, or deferred comp. If you have the potential to take those outside of the baseline year, that would then reduce the income that FAFSA is using in your baseline year to determine 4 years of financial aid. Managing capital gains very carefully in your baseline year. Don't take any big gains, big sales of houses or companies, etc., because that most definitely will spike your income, therefore increasing the student aid index and what a family is ultimately required to pay. Lastly, coordinating Roth conversions, as this might be a good idea for retirement. Planning those in the right year is important because, again, a conversion will spike your income for that taxable year. Any family wanting to make intentional and well-informed decisions about college should act now. But specifically, if you have a sophomore and we're in 2026, you definitely want to act now. You are currently in your baseline year, and we want to do everything possible to maximize the amount of financial aid that your family is eligible for. Every family will pay something for college, but the real question is how much and from where. If I can help provide guidance and understanding around your family's best plan to pay for college and protect your retirement, please don't hesitate to reach out. Thank you very much.